Hey everyone, welcome back to The Explainer. Today, we're diving straight into what I think is a literal masterclass in corporate resilience. We are tearing down the financials of LivaNova. Now, if you follow the medtech sector, you know they engineer devices for the head and heart. But you also know that turning around a massive, capital-intensive company like that is kind of like trying to steer a battleship. It takes time, precision, and a whole lot of strategic maneuvering. But looking at the data up to early 2026, LivaNova seems to have found their blueprint. We're going to dissect exactly how they executed this incredible financial pivot, piece by piece.
Okay, let's dive into this. Here is our roadmap for the breakdown. First, the LivaNova rebound. Second, restructuring the debt. Third, pay tied to performance. And finally, the Wall Street verdict. All right, kicking things off with part one, the LivaNova rebound.
So, back in 2024, LivaNova was bleeding cash, reporting a staggering net loss of $273.4 million. That is a heavy hit for any organization. But flip the calendar to 2025 and boom, you see a triumphant return to profitability with $109 million in net income. We are talking about a nearly $400 million swing in the bottom line in just 12 months. There is no way that happens accidentally. Management took a highly disciplined approach to expense control and funded their progress through the strength of their core businesses, which got them back to steady cash generation.
And this brilliantly illustrates exactly why that massive swing was so desperately needed. If you track LivaNova's 10-year cumulative total return against the S&P 500 and the S&P Healthcare Equipment Index, it's pretty clear they were underperforming the broader market and their peers for years. Literally, $100 invested in 2015 was losing value by 2024. The board and management knew the status quo was totally unsustainable. They had to make a radical shift to actually start delivering real value back to the shareholders.
Moving right along to Chapter 2, restructuring the debt, because you literally can't have a turnaround without following the money.
Let's unpack the mechanics of this debt shuffle, because it's a textbook example of buying time. They had old notes coming due in 2025, which, if cash is tight, is basically a ticking time bomb. So they smartly repurchased $230 million of those old 2025 notes. And how did they pay for it? They issued $345 million in brand new convertible senior notes, pushing the maturity date all the way out to 2029. And even better, they locked in a highly favorable 2.50% interest rate on that new unsecured debt. They also utilized privately negotiated capped calls, which actually brings us to a super important concept for retail investors.
Okay, let's cut through the jargon for a second. When a company issues convertible notes, it means the debt can eventually be swapped for shares of stock. If the stock price skyrockets, suddenly you've got millions of new shares flooding the market, and that dilutes the value of the shares that you and I might hold. So LivaNova essentially purchased these capped call derivatives from financial institutions as an insurance policy. It effectively caps the amount of dilution that can happen if the stock price goes up and those 2029 notes convert. It's a highly strategic move designed entirely to protect shareholder value while the company is growing.
All right, let's pivot to the human element in part 3, pay tied to performance.
Now, what's really interesting here is the sheer scale of the incentives. A little over $1.09 million. That is CEO Vladimir Makasaria's target short-term incentive plan bonus for 2026. Keep in mind, this isn't his base salary, and it is definitely not his long-term stock awards. This is just a one-year cash bonus target. The board is absolutely raising the stakes, making it crystal clear that exceptional performance will be met with exceptional reward. But they're not just handing it out. They've rigged the game so he only wins if the company wins. To earn that bonus, the board cooked up a really rigorous new formula for 2026. 75% of the CEO's payout relies strictly on hard financial metrics. The numbers just got to work out. But they dedicated a very intentional 25% to a non-financial component. And that is a fascinating shift in corporate governance. It's a direct recognition that long-term sustainability isn't just about spreadsheets, It's about the health of the organization itself. So let's break down that 75% financial chunk. Half of it, 50%, is driven purely by net sales. They have to grow the top line. But growth at any cost? Not allowed. 30% is tied to adjusted operating income, meaning they have to be profitable while they grow. And the remaining 20% is tied to adjusted free cash flow. They actually have to generate real cash. To translate the corporate speak here, if the executive team doesn't move the product, keep their expenses down, and put cash in the bank, their paychecks take a direct and immediate hit. It is a perfectly balanced triad of growth, profitability, and liquidity. Shifting gears to that 25% non-financial piece.
LivaNova's board demanded specific people-focused priorities. The CEO's bonus is now tied to emphasizing employee engagement, strengthening career development, ensuring succession planning, and cultivating a truly inclusive culture. And to prove they're actually serious about this, they brought in Natalia Kosmina as the new Chief Human Resources Officer in 2025. They get it. To sustain innovation in medtech, you have to retain top-tier talent. If the culture turns toxic, the CEO literally loses a quarter of his bonus.
Let's move to and see how this builds into our final section, the Wall Street verdict.
All that internal strategy leads right here to the concrete results. Thanks to double-digit growth in the first quarter of 2026, LivaNova officially raised its full-year 2026 adjusted diluted earnings per share guidance. The new range is $4.20 to $4.30. When management raises guidance this early in the year, it is a massive signal of confidence. They are straight up telling the market that the turnaround isn't just holding steady, it's actually accelerating faster than they initially modeled.
So you've got soaring net income, smart debt management pushing maturities way out to 2029, laser-focused CEO compensation, and now raised guidance from double-digit Q1 growth. Which begs the ultimate question: how are the analysts grading this performance right now?
So the crucial point is right here in the consensus data. Out of 11 polled financial analysts actively tracking the stock, the consensus rating is a really solid buy. Furthermore, they've set an average price target of $80.18. That represents an 8.60% projected upside from current trading levels. The big institutions are looking at the exact same data we just walked through, and they're essentially saying, yeah, we believe the strategy is working, and there is absolutely still room for this stock to run.
Which leaves us with a pretty provocative final thought. We've traced the entire arc today, going from a $270+ million loss to a highly disciplined cash-generating machine that is actively protecting shareholder value and investing heavily in its own culture. With a return to profitability, smart debt restructuring, and Q1 double-digit growth, is LivaNova the most compelling medical tech play of 2026? It's a seriously fascinating turnaround story, and an absolute one you should keep on your radar as the rest of the year unfolds. Thanks for joining me on this explainer. Keep learning, and I'll catch you on the next one.